Hi again, it's Billy. I'm going to spend a few minutes today just to give you a refresher course, if you will. I think it's important to go back and just build on the foundational principles of investor behavior and really what works and what has proven to work over the long term. In markets like this, when we get this up and down swings and news coming out that's negative and everyone asking questions, it's important to just to step away from it for a minute, fall back to what we know over time produces the best results. So in an environment like this, I always tell clients and friends and associates, you have to fall back on what you can control. Let go of what you can't. So let's talk about what you can control. Number one, setting your asset allocation and your risk tolerance. That should be unique to everybody, but you should set that and it should be customized to you and your strategy. And you shouldn't set a risk tolerance when you're at an emotional crisis. Set it when you're at a stable, level-headed time in your life. Also, your commitment to your unique financial plan will also give you guidance and be something that you should think about as you're going through a market cycle like this. And third is how you react when you're in a market swing or a downswing, especially how you react. Do you react emotionally? Do you change? Do you jump out of the ship? Do you bail on your plan? Or are you comfortable enough to know that you have this plan for a reason and it's there to weather the good and the bad? So again, the reaction to this type of an environment is very important. And I say reactions are most typical when we have the highest amount of emotion, whether it's on the downside or the upside. A lot of times people abandon their plan. They want to buy when things are really high and want to keep chasing it. But they want to sell when things are really low. They want to get out of it. They think it's the right move to avoid the pain. That's proven to be a wrong-footed move time and time again. What we can't control. Well, we can't control a lot of things the government does, policies around interest rates or government agencies and what they want to do to control us as citizens of our country and countries all over the globe, really. I mean, you see a lot of unrest. You see a lot of people dissatisfied with their governments in many countries. You see Sri Lanka uprising going on right now. You see people in China very dissatisfied. You saw that in Australia. So there's so many things that are going on around the globe that is getting people upset, and they want to rise up and they want to say something about that. So a lot of that stuff again is government mandates, lockdowns, things that we've we've found to not really work very well at all, if at all. So again, beyond our control, but we have to navigate it. Companies have to figure out how to navigate it, and we're again realizing that some of these things we just have to ride them out. Foreign investments and foreign events, I should say, are also things we can't control. The war, China, COVID lockdowns, again, things like that are going to cause news cycle. They're going to cause a little bit of investor fear, and it's going to create market sell-offs. The media is also something we can't control, and I hope by now you've watched me enough to know that my message is always the same. The media should not be relied upon, and it should not be used for your investment decisions. I tend to find that the media has become so biased and so irresponsible with their reporting that you almost have to completely avoid listening to them, and definitely don't use them for important decisions like your investment strategy. Too many of them just jump on whatever sells and fear and greed, and again they get into the emotional aspect of it. We saw that all through the pandemic. We saw it through Bitcoin craze, meme stock craze. I mean, they almost promote that type of thing. You'd think that they'd be there to protect investors, but they're not. So don't rely on them for your information, if you will. We also can't control irrational investor behavior. So we get into markets like this and people do crazy, stupid things, and we have to witness that. We have to watch the prices of good companies go down further than they should, and it's all due to fear and people jumping out when they shouldn't. Again, the greed and fear factors control investor behavior. The four words that are the worst enemy in the vocabulary of investors is this time it's different. And I hear that over and over again. People say that when markets are really good because they want to justify buying at a higher price or what they've bought at a high price. and they also say it on the when the markets are down because they are scared and they don't see any reason why the market would ever get good again. So that's happened throughout history over 100 years, and I've shown you many times, and Sean and I have both showed you charts that have multiple events and wars and situations that each and every episode was producing the same emotional reaction. This time different. This time we have that situation going on. This time we have this president. Well, we've been through all these types of scenarios and we always make our way out of it. And I know this time is different in a sense that we're dealing with inflation. So let's go back and talk a little bit about this this period that we're in, this inflationary period, and compare it to what we've seen in history historically. So the best time period I could find to compare us to is 1970s, where we had runaway inflation and we had major spending. We had a government that had the idea that spending was a good thing, and it became deficit spending. It was a period of reckless spending even. So we had runaway policies that were intended more for political gain than they were for responsible conservative running of the country. And under Nixon, we had the Keynesian economic policy was pretty much adopted. And for those of you who don't know, John Maynard Keynes was a uh, British economist back in the 1930s, and his big mantra was deficit spending, produce or spend more money in periods of downswing, and you'll build up on the upswing. We've been in deficit spending for a decade or more. Actually, the last time we had surplus budget was back in the Clinton administration, believe it or not. It's gotten out of hand, and I think politicians are just now accepted it as a fact that we shouldn't really worry about what we spend in government and Congress. And I truly believe that needs to end. I think we really need to focus on who are voting into office and hopefully come up with some strategies that we don't just give everybody what they want. We have to have some responsibility in Congress. I really think it would be important to have people, it would be required for congressmen and women to have a business background before they're eligible to run for office. I think that would be helpful, to be honest. Right now, we're running a $35 trillion national debt and climbing every day. The interest on that debt is upwards of $350 billion this year and climbing. As interest rates go up, we're going to see that continue to expand our deficit or our debt. So I think that's a big problem. I hope I'm not the only one, but it seems to be overlooked and just shrugged off like politicians who want to get reelected. It's all about getting reelected. But back in the 70s, we had a similar situation going on, and very few people who wanted to rein in that spending. Matter of fact, Nixon appointed Arthur Burns just to continue to push interest rates lower to allow for more and more spending and more inflation, and they weren't even worried about it. So it was a new phenomenon. We didn't really know what we were getting into then, and it took a very big change of policy. Paul Volcker came in and changed everything. It was tough. It was a very difficult period of years before they got inflation back under control because he had to raise interest rates up to nearly 20% in order to turn the economy back and get it on solid footing again. I'm not here predicting that we're going to go through another 20% interest rate cycle, but I know we're going quite a bit higher than we are now. I think the Fed's going to raise rates 6 or 7 more times. So one thing I wanted to do is share with you a couple of slides, and then I'm going to come back to my future comments here. So let me just go into what I think are the important slides to navigate. Right now we have the S&P 500 in a correction, right? We call it correction. Now we're calling it a bear market because we're down 20%. And I want to give you context around that. So if you look at the S&P 500 for the last 96 years, since they started recording data in 1926, we've averaged 10.5% return on that entire period of time, 10.5% per year. Now you have a number of negative years. We've had 25 of them actually in that period of time, and they've averaged 13.2% when they go down. 71 of the years actually were positive. So you had a 21.3% average annual return during those positive years. Well, that's pretty darn good and solid. And importantly, we look at these extreme declines of 28% or more, you see three of them. The most recent being 2008 in the great real estate collapse. On the extremes, on the upside though, the 28% or more, you see the majority of the years stacked over there in that column. It's interesting to me that I've gone through and looked at these as far as the years that you have listed here are almost always followed by a really tough year. So you have tough years or a couple years in a row, and then you see these strong bounce backs. And that's another reason why I continue to tell investors, hey, stay invested, don't abandon your plan. The markets always find a way to turn. And over the long term, if you're looking at a guide of almost 100 years, the markets average about 10.5%. That's a stronger return than I can find almost anywhere else. Now let's look at the history of downturns, because we're going to have to get comfortable or get used to these. You're going to have returns positive and negative, but over time you have to be willing to accept these downturns. 5%, 10%, 15, 20. They happen every so often. So 3 times a year on these 5% or more. But you go out to 20% or more, we're going to see those about every 5 years or so. And this is an index. The indexes reported are the S&P and the Dow Jones. And going back to 1942, so post-World War II era right there, 80 years worth of data, and you can see how the markets have behaved, but we're always going to see a correction occur every few years, and a 5% or more several times a year. Okay, that's normal stuff. So back to the conversation here then about what I think we need to expect or plan on going forward. I want to talk to you a little bit more about that, and then we'll wrap this up. So I think that going into next year and even this fall, let's talk about that first. So I want to give you some of my predictions for this year, political and economic. All right. Now this isn't a political channel. I don't want to get into that, but it does affect some of the things we are considering here financially and what might change in policy. So in the political arena, we have the midterms coming up. Obviously, people are talking about that on a daily basis. I do believe we'll have a change of party. I think that the current administration's having a tough time selling their agenda. You've seen that they've had to abandon most of their plans. You're seeing that most of the polls are talking about the red coming back into favor as far as the Republicans gaining seats in the House. You might even see a change of control in the Senate. There's growing probability that that's going to also occur. So some of the policies I think were failures were the lockdowns, the mandates, the forced terminations, and then currently the reckless spending. I think we're all talking about some of the same things. I'm giving you, for the most part, I think people agree with that because, we have an administration that's got an extremely low approval rating. Even if you voted for Biden, which again, I'm not telling you how to vote. I'm just telling you where the facts are right now. It's a very low approval rating on what's going on and what's happened since he took office. I don't believe for that reason, I don't believe he will run again in 2024. I think that the Democrat nominee will be somebody we haven't really thought about yet. It could be a popular celebrity come out, similar to Republicans nominating Ronald Reagan back in the 80s. I mean, it could be something like that for a popular Democrat candidate. Kamala Harris has absolutely no chance of being the nominee, in my opinion. Trump, on the other hand, on the Republican side, I think he's getting ready to make an announcement. I think he will make an announcement that he's running in 2024. He is still going to have to deal with the center crowd, the moderates, even left of center crowd, if he wants to gain popularity. We all know he's got the far right crowd, and that's not a problem for him, but his ego has been the problem with him gaining moderate votes. And to become more likable, to become more humble in his dealings, to hand out credit where credit is due, to be less harsh with his opponents and adversaries. His running mate's going to be important, I think, for him as far as him gaining traction in this next presidential election. There are several other candidates out there who might be formidable foes for him. I think even his former vice president Pence will run. There's a possibility that DeSantis will run. Some people would like to see Trump DeSantis. I don't know how that's going to play out, but time will tell. This getting back to a little bit more current cycle here and the economic fallout from where we're at, I think in the market itself, the downturn, we're in close to the seventh inning of this correction, if you will. And the equity markets are really just trying to right the ship. They're trying to price in how much Federal Reserve action is going to be necessary to tame inflation. And that's why we're seeing this slowdown, this hesitancy for investors to buy back in. I still think this is a good time to be dollar cost averaging. I think we're closer to the end of it than we are to the beginning of it. Now, seventh inning, if we have extra innings, that's still to be told. And that will be dictated a lot by current and future policy and some of the reaction there that we have, how hard the economy slows, what type of job losses we see. So the data points are going to be coming out, and we're going to be paying close attention to that. As you know, the Fed's going to be raising rates multiple times. They're going to raise rates next week by 0.75% or more. I think the next 6 months they're going to raise several more times. Again, 5 or 6 more times are priced in. Then we're going to see how inflation is reacting, right? They're going to continue to try to tame that and turn that back down. I think you're going to see out of that job losses, and you're going to see the unemployment rate start to climb. We're going to have to see people get back to work who are used to staying home because companies are going to start laying people off in order to save money in this economic downturn. And I'm just advising folks right now that if you don't have any skills and if you're not doing things where you're noticeable and visible, you might be the first area that is suffering the consequences. So make yourself visible, be able to do things, have skills, be noticeable to your employer. The ones who are staying home in their pajamas and refuse to do anything or go anywhere might have a problem. I think those are going to be the first jobs that are going to be lost in this downturn here. What other things are going to be affected? Well, of course, real estate. We haven't seen that yet, but real estate always follows equity markets when we're going into a contractionary period in the economy. So real estate is going to have a period of decline in value, and that's not really priced in yet, but it's coming. I'm telling investors right now, if you're selling your home, you better get quick and get going. If you're buying a home, again, you might want to wait a little while. Although interest rates are going to go up, that gives you the double-edged sword, but the prices need to come down in line with the demand. The demand is definitely going to dry up. There are not enough buyers who can afford homes with a mortgage rate of 6%. It was a much different scenario with 3% mortgages. So you're seeing the demand pool dry up, and you're also seeing people just decide, hey, I don't know if I feel comfortable buying a home right now. You know, my 401k value has dropped by 20%. I am feeling less wealthy. And a lot of these millennials who, again, were buying these startup homes and new homes, were fueling that with their feeling of wealth created by a false and a delusional cryptocurrency wallet that they had, which gave them a good feeling about how much money they had available and their net worth. So well, that's shrinking by 50, 60, 70%, and it's going to go further. We're needing to see this correction in that area because again, it was smoke and mirrors to begin with. A lot of these celebs and pro athletes who are on TV promoting it, you don't see them anymore. It's interesting, right? So I think a lot of this greed is being wiped out in front of our eyes, and it's again demographic in nature for the most part, but future generations I think will look back and they will ask a lot of questions about how an entire generation of people could get swept up in a mania like this. It's an interesting study in human behavior and psychology. What else do I think? I believe that dividend paying stocks are going to be attractive for investors. I think they'll gravitate to those types of areas and away from the high flying, high growth stocks that led the markets over the last 5 years or so. Dividends are going to become important again as investors want that stability and reliability, and they consider the dividend paying stocks or the blue chip stocks to be the most reliable and relatively speaking the safest in the pool of corporate equities, corporate stocks. So want to make sure that people know that we're already positioning in those areas, and we really like the dividends that are being paid by those companies, the good solid ones. I think corporate executives will also be out there in full force in the next couple of months talking about earnings and discussing the future of their businesses and the economy. They're going to talk about a pending recession quite often. They are trying to set the stage for lowered expectations and telling investors and the investment community as a whole that things are not turning yet and it's not going to be good for a while. So they try to lower that bar down to a very manageable level for the reason of being able to meet or exceed that bar in upcoming quarters. It gives that stock price a boost, and it kind of sets an easier, more attainable goal for them as the leader of the company. So watch for those things. They're going to be talking about layoffs, all these things to right the ship and to get their financial affairs in order. I just wish our government leaders had the same foresight. The last thing I want to say is patient and opportunistic investors will be rewarded once again in this environment. It happens time and time again. The markets will correct, and the investors who take advantage of these prices and buy while things are low and buy while the news is bad come out on the other side happy and smiling. And this is just, again, I'm just giving you historical data here, historical context that the markets recover. They always have. They always have found a way to do that. I know we're in an environment where there's a lot of news that's negative. There's a lot of things to be worried about, concerned about, and hope for a brighter future. But that's why prices are down. That's why the opportunity is upon us. So it's what you do in these markets that makes the difference. And I wanted to just give you that context, kind of some background. Hopefully that made some sense. And if you have any questions as a follow-up, please call me. I'd just be happy to talk to you about any of this stuff further. Until next time, you hang in and we'll talk to you soon.